Think an 800 credit score guarantees you a house? It doesn't. Right now, AI is scanning bank statements, not just your score, and silently flagging buy now, pay later activity like Klarna or Affirm. Even if you have never used them, you're still paying an 8% hidden tax on everything you buy right now. And it's to prop up the $46 billion of phantom debt of the people standing in line behind you. So the real question isn't your credit score. It's what the system thinks you're exposed to and how long before it counts against you. This is the Buy Now, Pay Later scam. Chapter 1. The Invisible 8% Surcharge. There's an invisible weight hanging around your neck at the supermarket checkout. When you use a credit card, there's on average a 1.3% to 3.5% transaction fee each time you tap. When you're using a Buy Now Pay Later app or BNPL company like Klarna or Affirm, they're imposing as much as 8% in processing fees on that same transaction. That's nearly 4 times as much as a regular credit card. It means companies are losing almost a tenth of the total price on each sale. That doesn't sound too bad, right? But there's no way those companies are going to absorb the extra costs. BNPL services love to tout their no surcharge clause, meaning that unlike credit cards, supermarkets can't add a direct additional cost to buy now, pay later payments to offset their losses. It seems pretty pro-consumer, right? Sure, they can't add a direct surcharge to buy now, pay later purchases, but they can raise prices across the board. That way, they distribute the hit across their entire revenue stream, kind of like a financial ballistic vest. Their profits are intact and you don't notice the shell game they've just played with you. The invisible tax they've added to every product just disappears in the larger tides of global inflation. The perfect crime. And you are the victim. But if it's creating all of this extra trouble, why do supermarkets and other small-time sellers play along? These are profit-making engines. They don't do anything unless they're getting something out of it. And when they're getting something out of it, it almost always means that we are losing something at the same time. And that's true here too. Retailers are happy to deal with the extra fuss because they're playing the long game. This isn't about getting a few extra pennies on the dollar. It's about fundamentally rewriting consumer psychology for their own benefit. That's right, buy now, pay later might seem like a little convenience, but it's actually brainwashing you every single time you use it. A 2024 study analyzed the purchase behavior of 275,000 consumers who used buy now, pay later services, and it discovered some unsettling consistencies. On average, not only did BNPL customers have a 10% larger basket size at the checkout, they also made a greater number of purchases that they wouldn't have otherwise made. This means that because BNPL gives you the illusion that you're paying less up front, you trick yourself into thinking you can spend more in one spree. This benefits both the BNPL service and the retailer, and it leaves you more cash poor as a result. This nasty little trick they're playing on you is called abstraction. It's part of the finance industry's larger quest to make money feel less tangible, less real, less immediate. That way, you won't feel as bad about spending more of it than you can afford. If making a purchase doesn't trigger money immediately leaving your account, it lessens the incentive to wait. Instead, you'll do exactly what they want, spend and spend and spend, and then worry about where the money is going to come from later. You're paying extra in stores to finance somebody else's burrito, all because the big corporations want to squeeze that money out of everyone in the long term. But when you look at it on a larger cultural level, you realize that inflation tax is just one symptom of a much bigger plague, and that plague is one our national debt has already caught. Chapter 2. The Phantom Debt Fog. A single person racking up sandwich debt on Klarna is one thing, but the actual 53.6 million Americans using it, more than the entire national population of South Korea, is a financial atom bomb. Welcome to the wild and shockingly unregulated world of consumer debt. In 2024 alone, there was $334 billion in global buy now, pay later transactions. Over 25% of American BNPL users have used it to pay for groceries. Installment plans aren't exactly a new process. People have been splitting up payments for huge purchases like cars and large pieces of furniture for as long as those consumer products have been on the market. What's the harm in doing the same for middle and low-grade consumer products, if you can just pay them back on time? If. And that two-letter word leads to phantom debt. Because BNPL businesses aren't under the same reporting obligations as banks or credit agencies, if you delay your payments, it won't leave a dent in your credit report. It's an outstanding debt you owe with no viable paper trail outside of the internal systems of your BNPL service of choice. But why does this matter? You just need to cast your mind back to the financial horrors of 2008. The problem at the heart of the global financial crisis was financial institutions knowingly giving out home loans to their clients that they couldn't pay back. And when the introductory repayment rate on those loans ended, homeowners couldn't pay back the money they owed, resulting in mass defaulting on their debts. The entire system collapsed from the ground up. It's why it's insanely important for financial institutions to be able to perform accurate risk assessments for everyone applying for a loan. But even if they have the best of intentions, they can't see the phantom debt lurking in the dark corners of your finances. They won't factor in those outstanding debts to your credit report, and that is a huge problem. Can a person who needs to extend their line of credit on a McDonald's order be trusted not to default on a home loan? It's like an invisible poison gas floating in the air around these seemingly innocent loans. But that's not the only dark thing that happens when you're haunted by phantom debt. Economists are calling it stacking, where consumers are loading up multiple small BNPL loans at one time. They extend their lines of credit, and they lose track of how much they actually owe at any given time. And this isn't a hypothetical to scare you. The Consumer Financial Protection Bureau found that in 2021 and 2022, 63% of BNPL borrowers had simultaneous loans at some point. That would be enough of a problem if all those debts were being generated on a single service. But the Bureau found that 33% of customers have loans across different services. It's a huge, terrifying financial spiderweb that's getting increasingly difficult for anyone to track without access to literal tons of papers of cross-person, cross-company financial records. Younger, lower-income Americans are the core BNPL user base, so the fact that BNPL debt is becoming a bigger part of the credit ecosystem is incredibly concerning. Tim Quinlan, a Wells Fargo economist, estimated that in 2023, spending through BNPL was as much as $46 billion, and it shows no signs of slowing down. Nearly 30% of U.S. consumers have used buy now, pay later services at some point, and as its effects on our economy seem to compound, it'll start looking like a more reasonable option for people looking to make ends meet. The debt bubble is growing in the dark, and the big three credit reporting agencies, Equifax, TransUnion, and Experian, are none the wiser. So if all of this is invisible to the government and major credit bureaus, what is holding this whole system together? And how are so many average people getting caught up in this web of lies and dangerous debt? To understand all the deceptions going on here, it's important that you first understand the one big lie that makes all of this possible. Chapter 3: The Anatomy of a Debt Trap. If the time bomb here is from people not repaying their loans, surely the solution is simple: regulating the system to make sure BNPL companies only work with people who have good credit. But that regulation doesn't exist. The wheels of lawmaking turn glacially slow. In the meantime, it seems almost like BNPL systems are designed to seek out the perfect victims for causing problems later on. We told you earlier how BNPL seems to rest on a psychological cheat code. If you push the true nature of the payment further down the road, the money stops feeling real. Spending it becomes a lot easier. It is the exact mechanism that retailers are counting on to actually make a return from buy now, pay later. A 1998 psychological study by Prelek and Lowenstein found that when you separate the purchasing and the paying, even by a little, the phenomenon they call the pain of paying gets soothed. And in the same way that physical pain keeps us out of a dangerous situation, this financial pain keeps us out of financially dangerous situations. Now BNPL is throwing open the door to that same situation and rolling out the welcome mat. Researchers at Stanford University decided to investigate the BNPL world further. They were captivated by how the specific BNPL method of pay in 4 seemed too good to be true. If you've ever used one of those services, you know exactly what we mean. You give the first 25% of the price up front and split the rest of the price into 3 more 25% chunks paid out over 6 weeks. Whatever BNPL service you signed up for fronts the cost and takes a chunk from the retailer. The money you pay back later is paying back the service, not the retailer itself. And if you make those repayments on time, the services love to brag that the deal is interest-free. But you don't need to scratch the surface very hard for things to start getting sinister. Unlike credit cards, these services don't require a credit check, which already automatically makes them like catnip for people who already have a history of defaulting on loans. This is an insanely dangerous self-selection process for an industry that relies on believing its customers will pay at a later date. Market intelligence firm CB Insight estimated that by the end of 2025, total loan volume from BNPL might have hit $1 trillion. In the words of Ed DeHaan, a professor of accounting at Stanford Graduate School of Business, the financial savviness of the average user is not great. Left to their own devices, the companies that issue credit tend to do so at consumers' expense when they can. But clearly, the average consumer is not getting the memo on that wariness. Average BNPL users have 4% more overdraft charges, 1.1% higher credit card interest, and 2.3% more credit card late charges than people who stay away from them. But that is the mild end. On the more severe end, people being offered BNPL options by their favorite retailers, there was an 8.9% increase in overdraft charges, a 2.5% increase in credit card interest, and an 8.4% increase in late fees. For the average user, that is $176 per year in extra charges, and for a severe case, it's $252. When you start to stretch those numbers across tens of millions of consumers, things start to get a lot uglier than just individual hidden fees. A study by the Federal Reserve Bank of Richmond said one potential concern is that BNPL usage may encourage some consumers to overborrow, thereby weakening their ability to service non-BNPL debt obligations. BNPL may serve as an entry point for risk accumulation that could spill over into other forms of consumer credit. Things are looking pretty rough for BNPL users. According to the CFPB, borrowers with weaker credit are driving the BNPL boom. Deep subprime consumers alone make up 45% of BNPL loans, with another 16% coming from subprime borrowers. But that's only part of the story. The same research shows that people aren't just relying on BNPL. In any given month, they can carry over $22,000 in unsecured debt on average. Surprisingly, only 17% of that is actually BNPL. In other words, BNPL doesn't seem to alleviate debt. It just shows up when the debt is already there, making things even worse. There's no such thing as free money without strings attached. And even worse, that string is currently tightening around everybody's necks in the worst possible way. Chapter 4: The FICO 10T Shockwave and Silent Rejections. The world of credit fundamentally wouldn't work without underwriters. They assess and assume the risk underlying any transaction, and the more risky transactions any financial institution makes, the closer they are to the danger zone. If you're looking for a loan or an insurance policy, it's an underwriter that does the due diligence. And those underwriters are about to take that phantom debt from all of your BNPL purchases and have a good long look at it. If you've been purchase happy with BNPL services, this could mean tough times are looming. One of the most important factors in your financial life is your FICO score, a score ranging from 300 to 850. It's determined from your payment history, credit utilization, length of credit history, and types of credit accounts. There's basically no way to overstate how important this score is to your borrowing life in the United States. According to Investopedia, it is the determining factor in about 90% of lending decisions. As of 2026, underwriters have started including your BNPL history as a factor in determining your score. And not only have they been trained to notice the telltale signs of BNPL spending in people's accounts, they've also started using AI models trained to flag this kind of behavior. What these models and underwriters find won't be improving credit scores of BNPL users, especially as failing to actually make payments is becoming an industry-wide trend. In a 2025 survey conducted by the credit platform LendingTree, 41% of users said they paid late within the last year. That's up from 34% in 2024. This is not an encouraging trend by any stretch of the imagination. When underwriters and AI models flag these delinquencies, the consequences could be dire. If you can't be trusted to pay back a $200 grocery bill over 6 weeks, how could they trust you with a 30-year mortgage? And it isn't just us saying this, it's the mortgage industry itself. According to Waterstone Mortgage, while BNPL payment methods may seem convenient and harmless, overuse of these services could negatively impact your mortgage approval or even delay your closing. If you're planning to go through the mortgage approval process soon, you may want to think twice about opening too many BNPL accounts or using them too frequently. Where it can really start assassinating your chances at homeownership is when it messes with your DTI, or debt-to-income ratio. These are all your monthly debt payments divided by gross monthly income, with the lowest ratio possible being ideal for lenders. It's one of the major determining factors in whether you can lock down a mortgage. Previously, before the credit industry could see your BNPL numbers, you might have appeared financially healthy. But with your BNPL payments factored into your DTI, you can be hamstrung, even if you're otherwise financially healthy. Your extra monthly debt might push you above 43% on your DTI, which mortgage lenders consider risky. In many cases, it'll lead to an automatic rejection. This is the problem with fintech, the industry that seems to fuse all the worst things about tech and financial institutions. You are sold an instant convenience by a company with a move fast and break things mentality, only to realize the thing being broken is your dreams of homeownership. And if that was the extent of the problem, it would be bad enough. But beneath this phantom debt, beneath the silent rejections, there's something even worse waiting for all of us. Chapter 5: The Securitization Time Bomb. Even if BNPL itself isn't a force that's going to solely bring down the entire economy, it is still just another step into a more dangerous direction for all of us. From abstracting currency to mounting debt, BNPL seems to be another road marker for our path toward the absolute nightmare of a post-ownership economy. Morgan Stanley has voiced concerns that BNPL could be a masking force that makes the true extent of consumer debt unknowable. But that feels like small potatoes compared to the larger societal risks. When money stops being psychologically real and credit lines can be forever extended, low-level payment never ends and true exchange never starts. Short of the oxygen you breathe, for now anyway, you'll just have a temporary grasp on pretty much everything. It'll be a renting economy run by our techno-feudal overlords, and you will just be one of the billions they'll be milking daily. Still hungry for scams? Check out the $3,600,000,000 North Korean super scam. Or watch this instead.